Welcome back as we move on to some other risk measures to complement VAR for risk assessment. We first learn some of the common sensitivity risk measures, followed by a quick discussion of sensitivity analysis. We'll also learn the various approaches to scenario analysis and the advantages and limitations of each approach. Let's get started. Most investment portfolios contain equity securities and/or fixed income securities. Some may also hold options or have securities with embedded options. The risk factors used to measure the risks of equities, fixed income securities, and options are all different. For equities, the most often used risk factor is beta, which we've learned under the CAPM model is a measure of the sensitivity of the stock's returns to the market's systematic risk. Stocks with beta greater than 1 are considered more risky than the overall stock market itself. For fixed income securities, we've learned in Level 1 that duration provides an estimate of how bond values are affected by changes in interest rates, which affects a bond's yield to maturity. For larger changes in the yield to maturity, the estimated change in bond price may not be accurate if we just use the duration, due to the curvature of the relationship. Making convexity adjustments may improve the estimates of the change in bond value. The estimated change in value of a fixed income security in response to a change in its yield to maturity is the duration-based estimate plus the convexity adjustment. For options, we've learned the option Greeks in the derivatives course. Delta is an estimate of the sensitivity of an option's value to changes in the value of the underlying asset. Delta is the ratio of the change in option value to a change in the price of the underlying security. For example, a call delta of 0.3 means that for every $1 increase in the price of the underlying asset, the call value increases by 30 cents. Like duration, the actual relationship between option value and the underlying may not be linear, so for larger changes in the underlying value, the estimate using delta may not be accurate. Like the convexity adjustment for duration, gamma is the adjustment to improve the estimate of the change in option. Gamma is a measure of how delta changes as the price of the underlying asset changes. We can estimate the change in option value based on the delta estimate plus the gamma adjustment. Besides the price of the underlying, another factor that affects option values is the volatility of the underlying. Vega is a measure of the sensitivity of an option's value to changes in the expected price volatility of the underlying asset. Taken together, we can incorporate all three of these option risk measures in the following equation. So we've learnt the various sensitivity risk measures to characterize the risk of a portfolio against a variety of risk factors. Sensitivity analysis is the process of determining the effect of a small change in a specific risk factor on the overall portfolio value, with all other factors remaining constant. The advantage over VAR is that sensitivity risk measures can inform a risk manager about a portfolio's exposure to a specific risk factor to facilitate risk management. For example, two bond portfolios with the same VAR may have very different exposure to interest rate risk. The duration of each portfolio can inform the manager on their level of interest rate risk and to decide if adjusting this risk is appropriate. If the analysis indicates an exposure to interest rate risk that is too high, the manager can take steps to reduce the duration of the bond portfolio. Of course, the focus here is in containing risks to adequate levels, not to eliminate risk. Portfolios not exposed to risk can only be expected to earn only the risk-free return. However, one shortcoming of sensitivity measure is that they generally do not consider volatility risk. Using the example of two bond portfolios again, let's say this time the two bond portfolios have the same duration. However, Portfolio A comprises mainly investment-grade bonds, but Portfolio B comprises mainly junk bonds. While they both have the same sensitivity to a 1 basis point credit spread movement, Portfolio B is inherently more risky as spreads are likely to move in greater magnitudes for junk bonds in response to the same stimulus. The duration measure fails to capture the volatility and standard deviation risk of the portfolio. While sensitivity analysis provides an estimate of the change in portfolio value due to a small change in a single risk factor, scenario analysis provides an estimate of the effect on portfolio value of a set of changes of significant magnitude in multiple risk factors. The changes in risk factors used in scenario analysis are often a set of changes that are expected to result in a significant decline in portfolio value, although a positive scenario may also be considered to estimate the gain in portfolio value. There are two main approaches to perform scenario analysis: historical approach and hypothetical approach. The historical scenario approach uses a set of changes in risk factors that have actually occurred in the past, usually significant financial disruption events, such as the global financial crisis of 2008 or the 2020 global pandemic. For equity securities, their price history during the event can be directly used to estimate their future performance, although using factor analysis is also possible. For fixed income securities and options, their historical prices for that period may not exist, as they may not have been issued. Even if historical prices for long-dated bonds do exist, they may not be relevant to the current characteristics of the instrument. For example, the price volatility of a maturing bond may be much lower than its historical volatility. Using its historical price history would mischaracterize the risk of the current portfolio holding. As such, valuation models are often needed for fixed income securities and options, even when using the historical scenarios approach. These modeled fixed income or derivatives holdings, together with the equity holdings, are repriced under the conditions that prevailed during the scenario period. Changes in interest rates, credit spreads, the underlying assets of the options, as well as the historical price changes in the equity portfolio would all be reflected in the repriced portfolio. The value of each position is recorded before and after these changes in order to arrive at the gain or loss that would occur under the chosen scenario. In most cases, the scenario is run as if the total price action movement across the period occurs instantaneously. In some cases, the scenario changes are modeled as incremental changes, and the scenario includes portfolio manager actions in response to each incremental change in the set of risk factors. The idea is to allow for the reduction or closing of some positions or adjusting hedges appropriately. Because such actions can reduce the overall impact of the scenario changes, scenario analysis based on incremental changes in risk factors is considered less conservative than the instantaneous model. It is more conservative to assume that there are no manager actions to mitigate the situation. The instantaneous model is more realistic in circumstances where the scenario unfolds very quickly, giving portfolio managers little time to react. The incremental model, on the other hand, is more realistic when the scenario slowly unfolds over weeks or months. One shortcoming of the historical scenario approach is that it is quite improbable that the exact same scenario will play out in precisely the same way in the future. Also, since it has happened in the past, managers are inclined to focus and take precautions that make their portfolios safer for a replay of that historical crisis, and that could, in a way, make their portfolios more vulnerable to a different crisis that has not yet happened. Due to such limitations, risk managers also use hypothetical scenarios, modeling somewhat extreme set of changes in risk factors that may not have occurred in the past. With a hypothetical scenario approach, any set of changes in risk factors can be used. They do not have to be aligned to historical experiences. That is, they may be extreme changes that have not occurred in the past, but have a non-zero chance of occurring. Scenario analysis is an open-ended exercise that could look at positive or negative events, although its most common application is to assess the negative outcomes. Stress tests are a form of scenario analysis intentionally focused on extreme negative events to assess the impact of such an event on the portfolio. Firms that use leverage, especially banks and hedge funds, often use stress tests involving a single risk factor to determine the size of change in that factor that could cause such losses that the firm's sustainability is compromised. Reverse stress testing is the process of identifying the portfolio or organization's most significant exposures. It is reverse because the risk manager first determines an unacceptable outcome, one that would threaten the survival of the organization, in order to identify scenarios of changes in risk factors that would result in such an outcome. The question then becomes how likely such scenarios are. Using scenario analysis in this way can be beneficial in helping risk managers identify the vulnerabilities of a portfolio and perhaps mitigate the risk exposures identified. The advantage of hypothetical scenario analysis is that they do not need to rely on history. Scenarios can be constructed to test the portfolio's vulnerability to a never-before-seen market movement. Besides, scenarios are not limited to any assumption of distributions. However, risk managers should note that hypothetical scenarios may incorrectly specify how the risk factors will co-move. Getting all factors and their relationships accurately represented in the suite of scenarios is a painstaking process, and it's unlikely to get everything perfectly congruous. Also, it is very difficult to establish the appropriate limits on a scenario analysis or stress test. The more extreme the scenario and the farther from historical experience, the less likely it is to be found believable or actionable by the management. In summary, we've learnt VAR, sensitivity risk measures, and scenario risk measures as the possible measures of a portfolio's risk, each of them complementing each other to give the risk manager a fuller picture of the portfolio or organization risk exposure. VAR is a measure of losses and the probability of large losses. Sensitivity risk measures capture changes in portfolio value in response to a change in a particular risk factor, but they do not tell us anything about the probability of a given change in value occurring. For example, a portfolio duration of 5 tells us that the portfolio value will decrease by 5% if interest rates rise by 1%, but it does not tell us how likely a 1% increase in interest rate will occur. Nonetheless, these sensitivity measures are still very useful in that they allow us to take a much more detailed look at the relationships driving the portfolio risk. If the risk manager finds the VAR unacceptable, the Sensitivity measures will guide him on what are the risk factors to hedge to reduce the portfolio VAR. Scenario analysis can be seen as the final step in the risk assessment and management process. For a firm that has limited its risk through a maximum VAR, limits on position sizes, limits on specific risk exposures, and so on, scenario analysis can provide additional information on a portfolio's vulnerability to a set of extreme changes in risk factors. And that concludes this lesson on sensitivity and scenario risk measures. Next, we learn the use of constraints in market risk management.